Welcome back to the Peterson Institute for International Economics. It's my pleasure to open today's sessions of the third symposium on ending too big to fail. As I think all of you know, the symposium has been a major initiative launched by the Minneapolis Fed to look at the current status and outlook for addressing the problems of too big to fail banks. Much credit to President Neel Kashkari, to, I want to make sure I get his title right, I know who he is, Executive Vice President Ron Feldman, and the team from Minneapolis Fed who've been showing both intellectual and communications leadership on this front. They've held two previous high-level symposia on the record in Minneapolis, one of which I and my Peterson Institute colleague Simon Johnson participated in. Another one I believe you had Ben Bernanke speak at. So, you know, it's reasonably high quality, and we hope to continue that level in today's discussion. But by virtue of the Fed Minneapolis partnering with the Peterson Institute, we hope to both bring it more to a Washington audience, but also to provide a bit more of an international perspective. And I'm very grateful to our many friends, distinguished colleagues in the audience today and participating on the program for helping us do that. I will not go into great detail about the motivations or the format or anything, just to say this is a completely on-the-record event. It is being webcast live. We are having two panels, as it were. The first, which will be chaired by Ron Feldman, and he'll introduce it, is focused on very analytical questions of the cost-benefit analysis of higher capital requirements for banks. Clearly, there's been a lot of progress on that front. Equally clearly, there are people and advocates out there, some of whom have appeared at other Fed Minneapolis symposia and on this stage, who would like to see a lot higher capital. And we're very pleased that our colleague Bill Klein, senior fellow at the Institute, will be leading off that panel with his own analytical, independent work on that topic. After allowing the people who are here in reality rather than virtually to grab lunch from the buffet, we will have a presentation, a speech of sorts from Neel Kashkari. I will introduce him more fully and fulsomely at that time. And then comments from our colleague Bertrand Baudret, who's visiting fellow at the Institute now and previously distinguished career in banking, both in the World Bank and in the private sector, and a few cheap shots from me. But let me turn it now over to Ron, who's worked closely with Bill Klein and I on putting this together, and he'll be introducing and hosting the first panel. Please. Usually, to make life easier for people, we just let the individual speakers come up, and then after everyone's presented, they can all sit in a row.
Well, thank you, Adam. Appreciate the introduction for the effort that we have underway with the Minneapolis Fed, and we're very pleased to partner with you today and to have you participate in the earlier symposium as well. So this discussion is about the benefits and costs of higher capital, as Adam already mentioned. And maybe to put it in some context, this is the third meeting that we have sponsored as part of our End Too Big to Fail initiative. And really, all of them have really focused on capital, even if they've been nominally about other topics. So we've had one session that was specifically with Professor Anat Admati that looked at higher capital levels. We had another session, as Adam already noted, that Simon Johnson kicked off about structural change reforms in the banking sector. But that, despite the fact that it was really about break up the banks, it had a strong capital component to it. And I think Simon's proposal actually is kicked off by the notion that banks have an option. Those that aren't well capitalized can go to a structural change, or they can use capital as a sort of as a counterpart. So capital was there too. And then finally, we've looked at the issue of taxing leverage outside of the banking system, with the notion if you have higher capital in the banking system and risks move to other institutions, you'd want to somehow protect against risk-taking not being covered by capital there. Again, something that's really tightly linked to what capital looks like in the banking system. So it's natural, given that context, to provide more details in thinking about capital, what levels seem appropriate relative to the benefits and costs that different options would present. And we're extremely fortunate that we have three speakers. On one hand, that might seem like a relatively narrow topic. On the other hand, we have three experts who actually have written pieces recently on that exact topic. So we're extremely fortunate that they're going to be here today talking about it. So I'm going to give just a general introduction for the individuals. The full bios are in the material, so I won't go there, but just suffice it to say that they have a deep level of expertise on these issues. So I think the first is Bill going to be the first presenter. So Bill Klein is a senior fellow here at the Peterson Institute. He's had a very distinguished career before that, including at the IIF and other places, and has written, I would really recommend that anyone who's interested in the topic look at his working paper that came out just several months ago, precisely on the economics of higher capital requirements, and which he'll be reviewing today. Then we're going to go to Giovanni Dell'Ariccia from the IMF, who also is part of a larger group that has written a piece on the benefits and costs of higher capital. And that's just one of many contributions he's made on the issues around banking, systemic crises, banking crises, and all of the related topics. And finally, we have Doug Elliott from Oliver and Wyman, previously of the Brookings Institution and previously of a wide range of institutions, who has been thinking about capital coming out of the crisis and how we should be thinking about what level of capital would be appropriate. And again, has written pieces when he was at Brookings and other places walking through cost of capital and how we should be thinking about the benefits and costs. So each member of the panel is going to be speaking for roughly 15 to 20 minutes, and then we'll reserve the rest of the time for Q&A. And with that, I'll turn it over to Bill.
Thank you very much, Ron, Adam. It's a pleasure to participate in the symposium. And my presentation will be based on two working papers that were handed out. The first is a test of the Modigliani-Miller theorem for banks. This theorem states that capital structure, debt versus equity, has no influence on the average cost of capital, even though debt is cheaper and equity is more expensive. The reason is that investors will reward a firm by charging a lower unit equity cost if the firm reduces its risk by reducing the ratio of debt to equity. Some academics, particularly Anat Admati and Martin Hellwig, have relied heavily on the Modigliani-Miller theorem to argue that far higher capital requirements, equity requirements, would not be costly to banks or the economy. So it's important to test whether this theorem holds. Now, one reason to think otherwise is that banks are inherently more debt-oriented. Half of their activity or more is debt. It's deposits. So they're locked into higher debt than, say, automobiles. A key to examining the overall cost of higher capital requirements to the economy is thus first to estimate the so-called Modigliani-Miller offset. What fraction of the direct increase in higher unit costs when you shift to more equity is offset by the reduction in the unit cost of equity thanks to lower risk? Now, my second paper uses my estimate of the M&M offset as a key input into the calculation of the optimal level for capital requirements for banks. This calculation requires or examines the benefits stemming from lower probability of banking crisis in comparison to the cost from the higher cost of capital, the resulting lower formation of capital stock, and consequently, a lower long-term level of economic output. Let me state the principal findings up front. First, only about 45% of the Modigliani-Miller offset attains in practice. Second, each percentage point increase in capital required relative to total assets imposes a reduction of 0.15 percentage point in the long-run level of GDP. Third, a banking crisis imposes damage equal to about 2/3 of 1 year's GDP in present value terms, including longer-term effects. Fourth, the optimal level for tangible common equity is 7 to 8% of total assets, corresponding to 12 to 14% of risk-weighted assets. Fifth, correspondingly, the optimal capital ratio is about 1/3 larger than the target set in Basel III. That is, for globally systemically important banks, the minimum tangible common equity under Basel III is 9.5% of risk-weighted assets. Starting with Modigliani-Miller. Their 1958 article states that the unit equity cost equals a sectoral capitalization rate, rho, if there is zero debt. As debt rises relative to equity, the unit cost of equity rises by the product of the debt-equity ratio and the excess of rho over the interest rate on debt. This equation can be estimated directly. My first test for large U.S. banks uses the earnings yield, or the inverse of the price-earnings ratio, as the measure of cost of equity, and finds the right sign, although a low coefficient and a not quite significant result. My second measure of cost of equity capital, the ratio of net earnings to book value of equity, does show a significant coefficient on debt to equity leverage and a larger coefficient. When I translate the average for the two coefficients, two models, into the effective Modigliani-Miller offset, I conclude that this offset is 45%. So slightly less than half of the potential extra capital costs from higher equity is neutralized by a lower unit cost of equity. Cost-benefit analysis of higher capital requirements then begins with a quantification of the typical damage caused by a banking crisis. This figure shows the path of actual outcomes through time t1 and an assumed continued trajectory thereafter. A large estimate of damage would be based on projecting growth from the peak of output before the crisis into the indefinite future. But typically, that peak will have been above potential output. So one should make the projection from the potential output before the crisis. But what would have happened to that capital that would have been built up, the capital stock that would have been built up if things had gone along as normal? Well, it doesn't have infinite life. It will depreciate. So at the end of my 15-year horizon, I eliminate the ongoing benefits or the ongoing losses so that the total cost of the damage is A plus B. This amounts, in my calculations, to, in present value terms, 64% of 1 year's base GDP. I estimate that the annual frequency of a banking crisis for industrial countries in the past 40 years has been 2.6%. So the annual expected cost from a banking crisis in an industrial country is 1.7% of GDP. That's the product of the 64% and the 2.6%. Next, one needs to calculate the benefits curve showing how higher capital reduces expected damages. The base damage in this equation would be 1.7% of the 2.6 times the 0.64. The probability of the crisis declines as the capital ratio K, and I'm using ratio to total assets, rises. it's got about a negative cubic relationship. It declines very rapidly. The benefit is the change in the probability as you have more capital multiplied by the damage in the base case. And the marginal benefit simply follows from that relationship. Now, I estimate this probability curve from the 2010 report of the Basel Committee, which had estimates based on many cross-country studies as well as sort of portfolio banking models. Now, their base probability is higher. They say that the risk in any given year is 4.6%. I think that's because they concentrate on too narrow a period. Recent years, obviously, there was an outbreak in massive number of banking crises. I use 2.6%, so I make that change. But otherwise, I keep the curvature in their response of a banking crisis to capitalization of the banks. Now, this curvature is steep. It shows, for example, the drop of about 3% in the probability of crisis when you go from 7 to 10% risk-weighted assets for capital, but a drop of only 0.4% when the ratio goes from 12 to 15%. I also show in this table the relationship against the capital to total assets ratio, which is smaller because total assets are considerably larger, about 75% larger than risk-weighted assets. So this is the resulting benefits curve for additional capital. It starts out steep, but the curve flattens to a plateau of about 1.6% of GDP once capital reaches about 9% of total assets. The next step then is to evaluate how costly additional capital to the banks would be to the economy. The average cost of capital to the banks, which is going to determine what they lend at, depends on the cost of equity, the rho, the interest rate, R, the capital ratio, K, and the Modigliani-Miller offset, mu. I assume that there is some spillover. When banks have to charge more for loans, non-banks are going to crank up their interest rates too. So I assume some spillover to financing by non-banks. In the U.S., about one-third of financing to corporates is from banks, about one-third is from non-banks, and about one-third is from internal funds. And that's the W. The weighted average cost of capital to firms in the economy is going to reflect the sourcing. So I then get the proportionate change in the average cost of capital to firms in the economy. Now, at this point, I decided to use the aggregate production function approach used by Miles, Yang, and Marchigiano. In this approach, the cost of higher capital expressed as a proportionate reduction in output depends on the proportionate increase in the cost of capital, which is the V, the responsiveness or so-called elasticity of output with respect to capital, which is the alpha, and the elasticity of substitution between capital and labor in producing goods, which is the sigma. For example, if the initial average cost of capital to firms is 10%, and if this cost rises by 1 percentage point to 11%, then with the capital share of 1/3 and a substitution elasticity of 0.5, total output would decline by 2.5%. you can calculate the marginal cost of additional capital by applying the chain of derivatives from the output impact to the price of capital to the cost of bank lending. This chain turns out to constitute a series of constants. So what we have is that there is a constant marginal cost to the economy of higher bank capital requirements. That means that the cost curve is a straight line sloping upward. You can then confront the benefits curve against the cost curve and identify the level of capital where the slopes are identical. This will be the optimal capital ratio for the economy. In my base case, the optimal ratio turns out to be a tangible common equity at 6.7% of total assets, or 12% of risk-weighted assets. I do a sensitivity analysis to calculate the optimal ratio using 3 alternative values for each of 7 key parameters, which results in about 2,200 combinations. For example, I set the damage from a banking crisis as low as 30% of GDP and as high as 100%, and the Modigliani-Miller offset as low as 35% and as high as 60%. This is the histogram that results from this exercise, and you can see that the median is 6.9%. The range is concentrated in about 6 to 9% of total assets. The 75th percentile is 7.9%. So my conclusion is that the optimal capital ratio is 7 to 8% of total assets. And that corresponds to 12 to 14% of risk-weighted assets using the average for Euro area and US banks. Now, it turns out that my results are consistent with a median of the leading models. Some of these models are what I call heuristic, or seawall. How high does the seawall have to be to protect you from the storm? Some are dynamic stochastic general equilibrium models. Most of them are calibrated optimization models similar to my approach. If you look at that, you'll note that the Ahmadi-Helwig entry is very much an outlier. Also, my numbers on this chart correspond to tangible common equity. So my range of 9 to 17% that I attribute to the IMF study that Giovanni will talk about corresponds to 15 to 23% for the broader concept of capital that they're, including Tier 2, that they're talking about. To recapitulate, my basic conclusion is that Basel III did not go far enough in setting capital requirements. However, the optimal ratio would be only about 1/3 higher than the Basel III target, instead of several times as high as some of the most extreme estimates would suggest. Finally, Basel III includes total loss absorbing capacity for the largest banks of 18% of risk-weighted assets. This includes contingent convertible debt and eligible subordinated debt, and it approximately doubles the tangible common equity requirement. Now, there's a substantial literature that argues that large banks take excessive risk because of the too big to fail subsidy. So I've done an unpublished note on this to test that. And it turns out that if the left half of this graph is, if you imagine a bottom line here, it's got the logarithm of assets, and it's... I would have paid for more ink, Bill. This place is always interested in more ink. Basically, the bottom line is that banks over 100 billion did not experience a larger proportionate drop in their net income relative to assets in the natural experiment of the Great Recession than did banks under 100 billion. Now, that still raises a question, it leaves a question, maybe TLAC is just fine. You know, I said 12 to 14% optimal capital ratio on the risk-weighted basis. TLAC, hey, the big guys have to have 18%, we're home free. But I think that TLAC is a poor substitute for equity. It has panic dynamics, as we saw just at the beginning of this year in Europe. And conceptually, it requires what amounts to bankruptcy proceedings for subordinated debt in order to mobilize it. Well, we want to avoid bankruptcy of banks. That's what causes panics in the first place. So it does seem to me that one wants to be cautious about how comfortable one is that the TLAC makes up for the equity requirement. Now, a further nuance is that U.S. banks already hold something close to the bottom end of my optimal range because they like to have a little cushion, something extra in the larder. So they're doing it on a voluntary basis. Well, this behavioral cushion might not be reliable, and I would suggest that prudence would favor making the target higher at my optimal range rather than leaving it that last mile on a voluntary basis. Thank you.
Morning, everybody, and thanks for the invitation. Let me start with the bureaucratic caveats. This is work I co-authored with Luc Chiad, Lev, and Huitong. Luc is now at the ECB, and the usual disclaimers apply. And on top of the one about the IMF here, I want to add one about the ECB. So these are our views. They're not necessarily reflecting the views of our institutions. So I'm going to talk about very quickly two exercises that we did, and borrowing from Bill, these are seawall frameworks. So we asked the question, if we look at past banking crises, how much capital it would have taken for banks, A, to absorb all losses through capital, so avoiding imposing losses on creditors, and B, how much capital it would have taken to avoid the public recapitalization. So let me give you the summary, and then we'll get into the details of how the sausage is made. So the summary is that we find that risk-weighted capital between 15 and 23% of risk-weighted assets would have avoided the large majority of these crises, when you define crisis as imposing losses on creditors or necessity, the need for bank recaps. In particular, I think for OECD countries, it would have avoided about 80% of these episodes. Not only that, but we find that there is quite a sharp discontinuity around that level. And so capital higher than this in OECD countries would have had only marginal benefits. The losses are much larger in emerging markets and low-income countries. This is not a surprise. These countries have less well-developed institutions for recouping non-performing loans. Banks tend to have less diversified portfolios, and they are subject to much larger macroeconomic shocks in general. So it's no surprise that the losses are larger. One compensating factor here is that they also tend to have much smaller banking systems relative to GDP. So that even if you have capitalizations that do not completely cover the losses in crisis, you still do not have very large needs in terms of fiscal support relative to GDP, just because the banking systems are much smaller. The final point, and this is primarily from an examination of the existing empirical evidence rather than our own original work, is that the costs of transitioning to higher capital standards are by an order of magnitude larger than the costs that these capital standards impose on society in steady state. And from this point of view, the obvious recommendation is to have a a gradual tightening. At the same time, one has to recognize that these are different from cars and emission standards, and markets may jump and impose themselves the higher standards immediately after they are announced. This is less likely in tranquil times, it's more likely in distressed times, but it's something to be cognizant of. So this is a chart where we plot the NPL ratio in past banking crises. The lines in red are OECD economists, the ones in blue are non-OECD. You see there is clearly an asymmetry in emerging markets having much larger NPLs. And let me now restrict the picture to OECD countries. And here you see that with a very few exceptions in which crises were truly disastrous events, the level of NPLs is pretty much, in most cases, below 20%. It's actually below 18%. And this is where we start our first exercise. And so, I don't know if you can read the table, but let's take the first column, and we say start from NPLs at 18%. And impose a loss given default on these loans between 50 and 75%, which are the data that we actually find in most advanced economies. Probably 75 is a better number for a systemic crisis. 50% is what happened typically in tranquil times. That gives you losses of about 13.5%. And we say, well, let's say that these banks have about 1.5% in provisioning that can absorb some of these losses ex ante. Then you have loan losses net of provision of about 12. We add a margin of safety of 1%. Actually, we play with this parameter as well, between 1 and 3. Just to say if we are getting something wrong with the calibrations, we have a margin. And we get, with the capital asset ratio, non-weighted, of about 13 in this case, with a 75% loss given default. Then if you want to convert it into risk-weighted asset numbers, you need to do something similar to what Bill just did, and depending on whether you take European or US numbers, you multiply between 1.75 and 2.5. And here at the bottom of these columns, you get with our upper range of about 23% of risk-weighted assets. As you see, this is like a brutal exercise. There is no general equilibrium model. We are not taking into account bank behavior. We are not looking at the cost of a crisis. We are not looking at the cost of equity. We are just saying, in past crises, if I take all the number and I crunch them down, how much it would have taken not to impose losses on creditors. And depending on how you play with these parameters, you get to a picture like this. So the blue line is as a loss given default of 50%. The red line has a loss given default of 75%. And you see, and on the horizontal axis, I put the risk-weighted capital ratio in percent, and on the vertical one is the proportion of past banking crises in which, with the theoretical capital of this level, we would have avoided losses imposed on creditors. And you see that the benefits are pretty evident at the beginning. So when you move from 0 and you start going up, and there seems, I don't know if I have a point. Oh, I did something very wrong. Okay. And you can see that around the 20% line, actually, depending on the two lines, is either at 15, 16, or 22, 23, you seem to have a discontinuity, and this is for OECD countries. And the main reason is that we only had 4 or 5 banking crises, which cut with NPLs much higher than 18. So once you get above that level, you stop reducing the frequency of crises in which you impose losses on creditors. So, of course, there are a number of parameters that you can change around this, and also a number of there is a significant uncertainty about some of the data. The one important thing with this exercise is that we have data on NPLs. We do not have data on losses on the security books of banks for the vast majority of this crisis. Now, it's reassuring that at least in the most recent one for which we have data, the losses were comparable. So we don't think we are that far. We are, I guess, in the same ballpark, but it's something to be kept in mind. There is bank heterogeneity, and I'll touch on that in a second. And going back to the comparison of emerging markets and advanced economies, as I said, losses are much larger in emerging markets. In the paper, there is a chart which is the brother of the one I just showed you for emerging markets. You see that everything is shifted up. But here I'm plotting losses in percent of GDP across crises and countries rather than in percent of bank assets. And you see that when you do it this way, the blue and red are essentially mixed together. There isn't that much of an asymmetry once you take into account the size of the markets. Another point about emerging markets that is sort of a little bit obvious, maybe, but is still worth stressing, is that in these countries, probably the first order of business, together with increasing capital ratios, is to improve the institutions and the procedures to recoup losses in banks. So if you improve property rights and bankruptcy procedures and the ability of banks to seize assets, probably you would bring losses much closer to those of advanced economies. So there has to be an effort on both fronts, increasing capital but also improving institutions. Now, the second exercise that we do starts from very, very different primitives, yet we luckily get very similar results. And here, essentially, we plot the public injection of capital into banks in recent banking crises for which we have data. And we make the following assumption. We assume that the authorities knew exactly what they were doing when they did this, and they brought banks to a level of capitalization that is where you would want them to be. So ex post, the level of capital is what you want it to be. And the question is, what would have been the capital ex ante sufficient to keep them there through the crisis without the need of public recaps? And when you do that, you find a picture pretty much like the previous one. It's a little bit lower. So here, the discontinuity is around 17% of risk-weighted assets. But basically, with that level, you would have avoided about 70% of recaps in advanced economies. So finally, before I get to the cost of capital, this is a picture of US and European banks for this exercise at the bank level. So these are recap at the individual bank level, because we were concerned that essentially by looking at the picture at the country level, it would mask substantial heterogeneity, so strong banks versus weak banks. And there is definitely a fair amount of that. But if you look at our range of 15 to 23% risk-weighted assets that we are considering, at 23%, you really would have covered basically every single bank, I think with the exception of one. Now, so far, as I said, this has been a seawall framework. So I haven't been talking about optimality in any way. So we are just saying, if you want to look at the past and use it as a measure, and then say how many crises you would have avoided with these numbers, this is the kind of framework that you want to have. Now, of course, this says nothing about A, the cost of capital, or B, the cost of a crisis and how you put the entire sausage together and decide where you want to be. And this was a conscious strategic decision on our part, because I think that there was already enough degrees of freedom in what we had done, and we wanted to have an exercise that is as transparent as possible. Now, that said, we look at the cost of capital not directly like Bill did, but we look at essentially a meta-study of the literature. And I think there are two observations. You can divide the literature in two branches. There is one that tries with very large models a general equilibrium approach to estimating the long-term cost of having higher capital in banks. This literature is admittedly not particularly well identified from an empirical point of view and finds very, very small numbers. So I think the numbers are smaller in general than what Bill just presented. According to those numbers, Ahmadi and Helvig is not that out there. You may want to have capital requirements in the 30% level if you believe those numbers. Now, then there is another branch of the literature that focuses on shocks to individual banks. This is a very well-identified approach in which, for example, is the Charlie Calomiri's papers using FSA data from the UK, where you look at how a bank reacts to a temporary imposition of higher capital standards by the regulator. You get enormous numbers there. You get a reduction in credit of about, I think, 5 to 7% for every percentage points of extra capital. Now, these are enormous numbers, and by those standards, we should go to zero. And, we would stimulate growth enormously if we just could cut capital at that level. Now, of course, in this case, the problem is that these are idiosyncratic shocks, which are very different from a systemic increase forever to higher capital standards. They are imposed on individual banks, typically because the bank has misbehaved one way or another, and they are temporary. And so the bank, of course, will tend to adapt on the asset side rather than on the liability side. So when you put these two things together, and that's one of the reasons we were a little bit skeptical of reaching a level of optimal capital requirement, and we chose to go to the seawall approach. You get a probably truth is in the middle, but I want to leave you with one picture, and these are the Tier 1 capital ratios, intermediation margins, and the domestic bank credit to GDP ratios in Europe and in the US, in blue in 2004, in red, and they are in 2014. So you see that one of the byproducts of the global financial crisis was through regulatory pressure and market pressure, a very sharp increase in bank capitalization. And if you believe that to some extent there was some degree of massaging the numbers, and there still is, but I think we would all agree that there was more massaging before the crisis than there is now. The increase is even bigger. The real increase is even bigger than what is depicted in these pictures. But we don't see a massive increase in intermediation margins, and we don't see a massive decrease in credit to GDP ratios. So to some extent, this points to the fact that the costs in steady state are not that large. Now, whether there is a discontinuity somewhere, and if we ask them to increase another 5 or 10 percentage points, we hit the discontinuity and the costs become much more significant is a different question. And another fair point about comparing these two pictures is that what is the counterfactual? Where would credit be if capital ratios were still what they were in 2004, in particular given the exceptional circumstances on the monetary policy front. And it may be that with more normal conditions, then the capitalization would matter more. And I'll leave it there. Thank you.
Hello, everyone. I'm Doug Elliott, and thank you for the opportunity to talk today. As was mentioned, I'm with the management consulting firm of Oliver Wyman. I think I was included with the idea that I would take a more industry-friendly point of view, and I probably will to some extent. But I do want to stress that Oliver Wyman actually does quite a lot of work for regulators, particularly in Europe. It's publicly known we've done a huge amount for the banking union, particularly the European Central Bank. So I don't want you to think that I'm speaking purely as someone who has a monetary interest in talking down capital levels. Also, some of the work I'll be referring to is my own when I was doing work with the IMF. So I'll take a little bit different viewpoint here, but some of this is quite consistent with what Bill and even Giovanni have said. The very short version here is that capital and liquidity are scarce and expensive resources for a bank, and therefore the allocation and pricing mechanisms for them have a large effect on what banks do. If you look at the literature on bank regulation, it actually predicts what I would describe, contrary to Giovanni, as fairly significant increases in bank funding costs from Basel III. And there may well be more as Basel III is finished, because there are a number of work streams still going. And there'd be some, at least partial, pass-through to borrowers from this. One thing I've been arguing for a while is it's important to think about banks and securities dealers as internal markets. Often we picture them instead as some sort of Soviet central planning type organization. And you get somewhat different conclusions if you look inside that box, and I'll try to talk about that a bit. I do think it's helpful to look at them as these internal markets. It's also important to recognize, as was probably implicit in the first two discussions, that regulatory requirements have become the binding constraints for banks in terms of capital levels, which indirectly determines business models and much of the specific behavior of banks. I'm not going to go heavily into this because Bill talked about it a fair amount, but since there are people out there effectively arguing that capital is at some social level free, I do think it's important to note there are good reasons why Modigliani-Miller does not fully work, that there's not a 100% offset, because Modigliani-Miller has a set of assumptions about the world, as most economic models do, and these assumptions we know to be violated in reality to significant extents. Tax preference for debt is one of those. There's also higher direct and even more importantly, higher indirect issuance costs for equity. I can come back to these later if you want. I guess the one thing I'd highlight, because it doesn't always get that much attention, is that Modigliani-Miller effectively assumes that markets operate such that there is a direct 100% trade-off between risk and return. And we know that to be false. I do not think there's a single study that has plausibly shown that there's a 100% offset. There's something less. And there is a long literature, including from Nobel Prize winners, suggesting that, in fact, there's a significant problem with that model of the world. Now, I don't want to overstate that because I believe directionally, as with Modigliani-Miller, it's true. But you have to remember, Modigliani-Miller assumes effectively a 100% correspondence. As a result of these various points, as Bill has talked about, most analysts find that the offset is somewhere between 25 and 75%. So the 45% certainly well within that range. And I'd like to emphasize that when I go through and quantify what the likely impacts are, they may seem small to you, but they're large actually in terms of the profit margins of the banks and therefore their ability to compete against other players. So to the extent that there are so-called shadow banks that can do similar activity without being forced to hold much higher capital, there's a severe competition problem that can develop. Now, one of the things we're handicapped with is there are, simply because it's very hard to do, very few empirical studies that look at historical changes in capital requirements and what the resulting impacts on funding costs were. But I would stress that the four I have here, and I think there's one or two others I don't have listed, they've all shown that there is an increase in the weighted average cost of capital as a result of being forced to go to higher capital levels. So the evidence certainly is not there for a 100% pass-through nor, as I said, given the assumptions that would be required for that to happen, one would one expect a 100% pass-through. All right, now I've got a complicated chart here, and I apologize for that, but you either have these charts already or they can be made available to you. They're out of a paper that we will be putting out, I think, in the month of July. So I apologize that not all the detail is here. But as a way of giving you a sense of what Basel III, not counting the additional work streams, which will add still more capital requirements, what Basel III may well do. We took for the U.S. it looks like it's 10 or a dozen studies that are out there, most of them from official institutions, including my personal favorite, Elliott, Soloy, and Santos, that I co-authored working with the IMF. And if you take these studies, their estimates of the gross impact on funding costs for banks, some of these studies then netted out some offsets, others didn't. So for comparability, I'm showing you the gross here, but since there are offsets, the net would be at least somewhat smaller. If you took these and then you looked at the change in capital held by banks from where we were at the end of 2011, which we felt to be sufficient time for market forces to have pushed capital levels to where they felt they had to be. Use that as a baseline, because I should just underline, it's really important when you look at regulation to decide what baseline you're going to use. It's not fair to go all the way back and compare it to the old requirements because everybody knew they were too low in terms of what a bank should actually hold. So very few banks held anything close to the minimums at the time. What we'd really like to know, I submit, is what would the market forces have caused banks to hold absent a change in regulation? So we've tried to capture that here. And then taking that change in equity as a base, we then multiplied each of these studies. Most of these studies provided the estimate for a 1 percentage point change in capital requirements. So we multiplied those by the change in percentage points. And this gives you at least a rough idea of what these studies would suggest that Basel III is doing, again, without the remaining work streams. So for the U.S., let's see, I don't actually remember what the median is, but you can see it's in the range of 70, 80 basis points. And we've plotted here a line representing the pre-tax return on assets that banks have had in the U.S. in recent years. If you go back further, a longer historical average is about 100 basis points rather than the 125, 130 that it's been more recently. So this is just to say, you can look at this and decide these are small numbers, but these changes are actually quite large in relation to the operating margins that the banks have, and therefore should be expected to have some significant effects. These are also, of course, aggregate numbers. Something I'll come back to later is that different types of business is affected to a much greater or lesser extent. And so there are distributional impacts in terms of that. Then I show the figures for Europe as well. The way we've calculated them, they're a bit lower. On the other hand, the pre-tax return on assets is quite substantially lower, and also was historically too. So again, you're talking about something in the general range, or in the case of Europe, probably over the return on assets. Okay, well, how does this all translate into bank behavior? The easiest way to think about it is almost all banks, certainly all sophisticated ones, have loan pricing formulas. So they basically require, if you want to make a loan, you go to your credit committee and you have to show them that you're charging enough to cover your expected losses, your expenses, and also the cost of capital. And the cost of capital is significant enough in the case of loans that it matters how you decide how much capital to allocate to this. And by the way, other services, trading activities, et cetera, do an analogous thing. It's just easiest to understand with lending. And increasingly, liquidity costs are being folded into this as well. Now, there are actually quite a number of ways you could decide how much capital to use. So for some banks, they are using the single most binding constraint that they have at the time. And that's generally what academics would assume that a bank would do. And that could be risk weights, either version, either the advanced or the standardized version. Could be a leverage ratio. It could be backing out what a stress test would effectively give you as risk weights. But for many banks, they don't know what the most binding constraint will be over the life of the loan or the activity that's taking place. And therefore, they feel they need to have a blended approach so that they won't have to make a radical shift in business if the constraint that's most binding changes. Goldman Sachs has indicated publicly that they use a weighting of 5 factors: 2 versions of risk weights, 2 versions of the U.S. stress tests, and the supplementary leverage ratio. There are other approaches you could take too, and I should stress these internal mechanisms are in a state of flux. Now, a point I'd like to stress is that for very good reasons, regulators have moved to the point where the capital requirements they've put in place are significantly higher than banks would arrive at on their own, or that rating agencies would arrive at on their own, or that funders would arrive at on their own. It's basically because there's been a sensible decision to force banks to internalize the economic externalities of financial crises, much like we either charge for pollution or in that case you can sometimes outlaw it completely. But the idea is there's effectively a Pigovian tax here in the form of a capital requirement. Well, once you reach the point that capital requirements imposed by regulators are significantly greater than anyone else would impose on them, including their internal models, then you've reached a situation where the exact form of those regulations will seriously affect the decisions that are made. Which types of loans will be done, how much will be charged, what other types of activities will be done. Now, I stress this because there is a minority of the policy community that argues against this point and effectively says, we'd like you to have the total amount of capital and liquidity based on our requirements, but we'd like you to make your internal decisions as if those weren't there. You should use your own way of calculating the risk, like an economic capital model. I can tell you that's not how banks are going to operate, and most of them don't operate that way now. When you have a scarce and expensive resource and the regulators are deciding how much you need of those, you will allocate that internally, which means we just need to be careful about how it all comes together and what the implications are, what the incentives are from that. How much time do I have left, by the way? I'm not sure if I'm taking too much or not. All right, thank you. All right, since this is a policy audience, I do want to talk a little bit about how to improve impact analysis. That is the cost-benefit analysis here. I argue that it would be very useful to take a micro approach that looks at how these banks operate. And that requires detailed modeling of the internal workings of these banks. A frustration I have as a non-economist is economists are really good at studying markets, yet these are important markets that I've seen almost no study on. So I would encourage those of you in the economics profession to look and to see if some of the tools that work so well with external markets could be applied here. I think in part this is going to require some management science in terms of examining how firms actually operate and the organizational behavior issues that are involved in that. And some of this is going to be pragmatic fact gathering, surveys, interviews with senior managers and junior managers, since they do a lot of the actual decision making. And without these things, I think it's difficult to know the full implications. But I do, on the next page, have a few initial conclusions that I came to that are fairly clear just from taking this overall approach. One is that, ironically, even though most regulators seem to want to move away from universal banking, I don't feel that particularly strongly, but many regulators do. We've got a system with multiple constraints of capital and liquidity that interact in complex ways that actually encourage universal banking. So if you think about it, if you were to take a Morgan Stanley or a Goldman Sachs and break them up between their trading, their markets activities, and their lending activities, each of them would have to shrink because they'd each be bound, each piece would find their most binding constraint more binding. Risk-weighted assets on one side, leverage on the other. Whereas when you keep them combined in one entity, you are able, essentially one unit can kind of borrow some of the excess regulatory capacity from the other. I also think that the difficulty of modifying these internal allocation approaches and of knowing what the right thing to do is, particularly with all the regulatory uncertainty, is one reason there's been a level of delayed reaction in terms of the total effects of the capital and liquidity changes playing through into impacts on the customers. And the third point is, for those like me who worry that the leverage ratio, while good as a backstop, has bad incentive effects if it's the binding constraint under most circumstances because it's risk blind. For those who worry that it incentivizes riskier behavior, if you're looking at a bank which is using a blended average of the different capital requirements, they already are reflecting the leverage requirement to some extent, as Goldman Sachs we know is. So let me leave it there. Thank you very much.
So we're going to open it up for Q&A to the questions. So folks that are interested, why don't you just raise your hand and state your affiliation and direct your question to the entire panel or a specific panelist. Mark?
This is two related questions for Bill and Giovanni. From your presentations, it felt like your analysis was kind of static. And I think in a more dynamic world, there are two considerations that push in opposite directions. One consideration is that after, the badness is over and the losses have been absorbed, the institution has to keep operating, so it can't be left with slightly above zero capital. So this is just a question, what did you assume about the amount of buffer you need to start with such that you're still adequately capitalized after the crisis has happened? And then the second question is, the first U.S. stress test, the one in 2009, a lot of people discovered that as the crisis is unfolding and losses are being absorbed, gross operating income is coming in. And that gross operating income actually represents a significant resource in terms of loss absorbing capacity. So in your calculations, do you have an assumption about absorption from gross operating income or an assumption about how quickly the losses are absorbed? Because if not, then maybe the capital requirements are a little too high. Thank you.
Bill, do you want to start?
Sure. My analysis is very much what's the long term. It's a sort of economics, graduate economics 101. You got a output on the left-hand side, and you got capital and labor on the right-hand side. And if you do something institutionally, which, artificially, or which constrains the amount of one of those inputs, then on the left-hand side, you're going to have less output in the long term. So I wouldn't call it static. It's almost the opposite of static because, in a sense, these transitional things, here's where I'm finding myself a little bit in a difference with Giovanni, is that transitional costs high, long-term costs low. What we've seen is at least the observed increases in or difficulties in implementing the increases so far have not been that great. So anyway, that's a sort of a separate issue. But I would try to emphasize that I don't consider my analysis to be static in that sense. Now, it is true that, in principle, what you would want to have is enough capital so that when you hit the crisis, you go down fairly low. I would say at the depth of the crisis, you got to have 2.5% of total assets left as capital, something like that. One thing I think this whole discussion forgets is Bagehot's law, right? We've had a central banking principle since 1870 that banks should, in fact, get liquidity support. They should not be supported when they have an insolvency. And a lot of the discussion, it seems to me, tends to, because in the extreme, that assumes that you can have your capital go all the way to zero. You don't want to go below zero. Anyway, that's the first part of that. Yeah, gross income coming in. Sure, that's exactly what Cohen has found about how we have adjusted. When the banking requirements went up, the capital requirements went up, instead of cranking down loans, what banks did was to retain earnings. And so that did contribute to meeting the higher capital requirements.
Very quickly, on the first one, no. So as I said, what the exercise is about, at least the first one, I think you could think that the second one somehow has an implicit buffer. That's what the authorities wanted to achieve. But the one based on NPLs, we just look at what is the threshold not to impose losses on creditors. And you have a point. That doesn't mean that these remain economically viable banks. It doesn't mean that they are still lending. I think what it means is that recapitalizing them through the private sector is certainly easier than if they were in negative equity, but you have a point. On the second one, again, no. And on top of that, so maybe the two things balance each other. I don't know. The other thing that we don't take into account is something that Maurice pointed out to us is policy actions, right? So again, we do not have a model here. We just look at actual data. We look at the frequency of NPLs in different banking crises, and the sausage is pretty transparent here. This is what you put in, you get out. And for example, you would imagine that in all these crises there have been supportive actions through macro or other means that limited the amount of NPLs relative to a framework of true laissez-faire. So if you really wanted to go to a framework where the government doesn't need to intervene, you would have to have bigger buffers.
Okay, let's see. Additional questions? Yes. And if you could state your affiliation, that'd be great.
Paul Gallagher, EIR News Service. I'd like to ask a question that also refers back to the previous symposium in this series, because you've covered a lot of the ground of the 1933 debate, early 1933. On one side, much more capital for banks associated with consolidation of smaller banks into larger banks, and a cost to the economy in the form of less lending credit. On the other side, completely separating commercial bank holding companies from securities activities and imposing losses on the securities markets. And as Professor Zingalis said in his luncheon presentation at the previous symposium, it's certainly easy to devise such regulations for the banking system which are, quote unquote, better than Glass-Steagall. But Glass-Steagall was chosen the last time. It worked for a long period of time while it was enforced. And that, in his view, overrode the, quote unquote, better than Glass-Steagall aspects of other schemes that are devised. So I'd like to ask you, how do you respond to Professor Zingala's assertions at the luncheon speech in the last symposium?
Sure. So I'm going to direct that to our panelists, and I'll just slightly rephrase it, which is you've talked about capital and thinking about the benefits and costs of higher capital. They're all alternative ways of thinking about responding to the concern people have about too big to fail, which would include structural changes, for example, splitting commercial and investment banks. Is there, in your thinking about capital, have you thought about the pros and cons of structural change relative to the capital analysis that you've done? I recognize it's a little bit off the topic, but you're all well versed in the debate, and so maybe you have some views on it. We can just start. Yeah, why don't we start from Doug and work our way this way?
Sure. I think there's actually very little evidence that the structural reforms you're talking about would decrease the chance of a crisis or the severity of a crisis. It's all well and good to assert that it's the case, but I have not seen any particular evidence, and I have plenty of reason, including the last crisis, to think that it probably isn't the case. We had to rescue the investment banks this last crisis, banks that were pretty purely investment bank, even if they had small amounts of commercial banking activity, just as we had to rescue some of the commercial banks that were pretty purely commercial banks. I would need to see a whole lot more evidence that there was good reason to expect greater stability before I would prefer that to more capital.
Yeah, I don't know exactly what Luigi said in the previous symposium, but my sense is that what we look at was purely capital and essentially purely commercial banks. Some of the points that were made in other presentations pointed to the fact that as you increase requirements on commercial banks, there will be a tendency by markets to replace banks with other animals. And from that point of view, you need to think about the regulatory umbrella in a more holistic way. So it's not just capital, or it's not just the structures. The two things go together. So as you have financial intermediaries that are non-banks and become more systemic, you need to do something about that at the same time. So I'll stop there. I don't want to go too much off script here.
If you look at the literature on the risk-taking as a function of the size of banks, some things kind of strike me. There used to be a charter value concept that was in the literature that said, well, you know, if you take J.P. Morgan and the guy's looking at the portrait of the founder over his shoulder, he's not going to go out and gamble. He's going to want to preserve the charter value of the bank. Then if you turn around and look at some of the theory, it's that the large banks doing all these various things do have a too big to fail subsidy to taking risk. I think there's some interesting questions there. Not immediately obvious to me that a lower unit cost changes the utility function of the planner. But I think one of the issues is that size of banks tends to provide a certain amount of additional risk diversification. So then the question is, you know, in some sense, there's some reduction in risk to the system from having a more diversified set of larger banks. And as I say, that scatter diagram I thought was rather telling, that you did not have a huge plunge in the large banks' net income relative to the smaller banks' net income in this natural experiment that we had. Now, should there be a Volcker law? Should there be a more rigorous division? I too find it quite telling that it was, these much more leveraged Lehman Brothers, Bear Stearns, et cetera. And in fact, some of the big banks were part of the solution rather than the problem because they took over some of these houses rather than having them, Bear Stearns, for example, rather than letting them fail. Anyway, all of this is kind of an amorphous answer. Probably what I should have said is that's not my department, says Rainer von Braun. But these are some sort of reactions.
I thought the panelists did a nice job covering a topic that they all claim that they know nothing about. Any other questions from the audience?
Tara Rice, Treasury. So one quick comment and then a question. So Basel III restricts what is included as eligible capital. In other words, it's taking out a bunch of items that we now consider quote unquote ineligible, like deferred tax assets, deferred tax credits, goodwill. So my comment is simply that the capital that we're calculating pre-crisis isn't really, in my mind, the capital that existed. And so I think that some of these calculations should adjust for that capital level, which would make pre-crisis look much smaller. And my comment, or my question rather, is for Doug. So I've heard this argument before, and maybe you can explain a little bit better. So I think what you're saying is banks don't do capital allocation across business models very well, that they tend to just allocate by business model rather bluntly. And so we can't expect them to model, say, one kind of business model will take X percent capital, while another will take a different percent. I think that's what you're saying, but could you, it's not. Okay, so could you describe then why banks can't efficiently model their internal capital allocation? And then I understand that there's some uncertainty about how the different regulations will play in, but also if you could talk about maybe internally how capital leverage and Tier 1 and different regs might make this more difficult.
Sure, and I apologize. I must not have explained well to leave you with that question. No, if anything, my argument is the reverse, that banks are fairly sophisticated about taking account of these requirements. The uncertainties right now are twofold. They've gone from a world in which there were much, much simpler capital requirements on the regulatory side to a world in which you have, as with Goldman, you have 5 different capital requirements that could be binding on them over time. You have to mesh it with liquidity requirements as well. And sometimes a liquidity requirement may pull you in one direction and one of the capital requirements pulls you in another, just as 2 different capital requirements could pull you in 2 different directions once you get down to the incentive effects. We have essentially no academic research to give a good framework for making these decisions. So if you're sitting there at a bank, you're busy implementing all the Dodd-Frank requirements that have been placed on top of you, the various Basel rules, et cetera. There are a lot of other pressures. There's financial technology that's beating you up. In the middle of this, you've got to somehow step back and figure out how to take account of this very uncertain environment. And it just takes them some time. I mean, a leader like Goldman Sachs has moved faster, though I'm sure they'll end up recalibrating as they go also. But let me just give you some examples. If it's not clear what would be so difficult about this, if you could potentially have any of several requirements be the binding one on you a year from now and you're making a multi-year transaction, like a loan, then you don't want to go with just the currently binding constraint because maybe one of these others will turn out to be binding. But for you to do anything more than just the currently binding constraint means you effectively have to hold some extra capital as a buffer. You're effectively paying insurance in order to protect against discovering that a different requirement turns out to be your binding one. It's very complex to figure out what's the right amount of insurance you should be buying. And since there's some things like the U.S. stress tests, the Federal Reserve is deliberately making it impossible to know what the test will be the next year. There's a level of continuity, but also a deliberate level of change, partly to avoid gaming. It's just a complex exercise, is all I'm saying. At the same time, though, some version of this is important for these banks to do, and they know it. So they are making adjustments, and the incentive effects are playing through already, but I think they'll play through significantly more as everything settles down.
Great. I think we had a question here.
Thank you. First, thanks for the thought-provoking pieces on these key issues, and I'm, Doug, looking forward to the paper in July. Dennis Kelleher, Better Markets. There's a lot of things to think about, one of which is the assumption that kind of behind this, which is all banks are the same. Wells Fargo is not J.P. Morgan Chase, is not Goldman Sachs. So the amount they contribute actually to the real economy on loans or otherwise, and therefore the plus or minus to GDP are quite different. And I think the nuance analysis in that arena, I think, needs to be paid a lot more attention to. I mean, John Kay had an interesting thing out recently saying that, now I'm not agreeing with this, but something like 10% of what Goldman Sachs does actually has any relationship to the real economy. I'm not validating that. And what the real economy is and what the 10% is a big argument. But I'm just saying Goldman Sachs is not Wells Fargo. And it seems to me that nuance should be included in the analysis. And there's a number of other things, including, Bill, your assumption that GDP is going to return to trend over a period of time, whatever the period of time is, when there seems to be a pretty good argument that returning to trend may never actually happen or may not happen for much longer. But the bottom line, too, is that you're trying to compare, I think, calculate incomparable costs and benefits. So if you think about it, in November of 2009, the U6 rate was 17%. That's 27 million Americans. The impact actually was on 50 million Americans when you consider how many of the 27 million Americans underemployed were heads of households. And you go to underwater homes, about a third of all homes in the United States were underwater in the first quarter of 2010. You could just keep going through that. And you don't have to look at it historically, look at it today. Today, the U6 rate is 9.9%. Underwater homes today are 12.8%. Extraordinary Fed policy still continuing. What are the implications of that? And so when you're calculating capital or leverage or add in all of the other aspects of financial reform, Doug, that you've talked about quite a bit over the years on the one side, and on the other side you put real people and real economies, I think you've got to be looking for a margin of error on the capital side, not on the people side. And in thinking about that, and I'll conclude on this, one of the ways to think about this is that financial regulation, whether it's capital or other pieces, actually don't add any incremental costs. What it addresses is when those costs are going to be incurred and who pays them. So you can not pay them pre-crisis, which is to say keep your cost of capital down, therefore the argument that higher growth, lower cost of loans, and you come to a crisis, then you pay for the crisis. And who pays for the crisis? Well, we do know it's 50 million Americans, or however you want to add that up. That's when they pay. So who pays will be the public, and they'll pay to clean up the mess. Or the payment is before the crisis, incrementally over time based on the layers of financial regulation, which admittedly have a cost. But the issue isn't that there's no cost over here. There's only a cost of financial reform or financial regulation over here. So the real issue is there in fact incremental cost? How do you calculate the incremental cost? And who in fact pays it? That, I think, is a different level of analysis that gets overlooked.
Do any of the I could sort of rephrase that as a question, or do any of the panelists want to respond to it as it's currently?
A couple specific things.
Sure, that sounds okay. Why don't you go ahead, Bill?
First of all, I don't assume that output returns to its pre-crisis trend even at the potential. But in order to calculate how much that area B, whether it should be area B or the entire gap between the bottom and the middle line for the rest of eternity, I believe there's a finite limit of life of capital, so that's the way that I calculate it. I'm not saying that. The broader questions you're saying was, how about let's put some welfare weights into all of this, and let's look at the distribution of the damages to a utility function. Let's weight the poor higher than you weight the rich, and let's have those weights be taken into the account into calculus. One could do that. It's not blindingly obvious to me that the poor are going to be better off over the next 40 years with a situation which cranks down the general level of capital stock and therefore output of the economy. And here I continue to disagree a bit. On this question, I think some of the stuff is the question of do you use macro models and do a survey of macro models, and when you do the survey of macro models, have you sorted out the induced response of monetary policy? Have you sorted out assumptions about, well, it would be impossible theoretically in this model to have total less capital because of X. So I'm skeptical of those, some of the lower macro model estimates. That's why I use the Miles et al. Much more transparent production function approach. So I guess the bottom line in a sense is that is my 64% 1 year's permanent loss too low? I did include a variant in which I cranked it up, I think something like 300%. It turns out that because of that extremely punitive, or if you want to look at it that way, tapering off of the benefits, you don't do an awful lot more. Anyway, those are some responses to the specific parts of your question.
Yeah, I mean, I don't have much to say. As I said in the presentation, this is exactly the kind of discussion we try to stay away from. Not because we think it's not important. It is very important, but just because, as my advisor used to say, Rudy Dorbush, is one idea, one paper. And we try to focus the paper on these specifics. But I think you do have a point. I think that to calibrate a model to the cost of a crisis, it's incredibly hard. And actually to calibrate the models to the social cost of capital, which is a different thing from the cost of capital for the current shareholders of banks, is a very difficult thing to do. So, for example, given capital is more expensive than debt for the banks, this money goes somewhere. So the people that are holding capital will be richer than if they were holding debt, and somehow this will feed back into the economy and will smooth out the cost. So to have a true general equilibrium model of the social cost of capital is very, very hard. And it's not that we didn't think about it. One obvious thing is that there are agents in the economy that like fixed income securities, say deposits. You don't like the idea that you have a mutual fund instead of a checking account, and every day you need to check what is the balance, unless you assume the banks are going to expand their portfolio. If you decrease leverage, let's be specific, you're going to have a smaller supply of these assets for people. That is a cost. How you quantify it, I don't know. But I'm very sympathetic to your view that the crises are very expensive things. They cast long shadows, both in economics and social terms. We are seeing it today in most of Europe. And so this is why we said the seawall approach maybe is a legitimate one. And to make a joke, you can have a guidance system to go to the moon. The question is whether you want to hit the moon or a specific crater. And sometimes if you try to hit the crater, you miss the moon. So the idea of much less leverage it was appealing to us.
So Doug, we're going to give you the last word, but you have 30 seconds to provide it.
Oh, God, the pressure. First of all, you raise important points about social values, et cetera. So I don't want to downplay them. But it also is important to realize that slower growth has a real impact on ordinary people, perhaps, and a higher impact even on poor people. You've looked at what Europe is struggling with these last few years. The social costs of slow growth or occasionally negative growth is pretty bad. So crises are terrible things. A long period of repressed growth is also not a very good thing. it's hard to balance.
Great. Well, I want to thank Bill and Giovanni and Doug for their comments, and turn it back over to Adam.
And I want to thank Ron for leading the discussion. Ron and Bill really put together this morning's part of the program, and I want to thank them on behalf of both the Peterson Institute and the bank, Federal Reserve Bank of Minneapolis. Our friends who are out there in virtual reality, we're going to take a short break. Our friends and colleagues who are with us today, there is free lunch for those of you not too big to eat. And that doesn't count me, unfortunately, at the back. And we will reconvene in 15 minutes for remarks by Federal Reserve Bank of Minneapolis President Neil Kashkari. Thank you very much.